Hello everyone, and many thanks once again for tuning in to another of our investment videos. With US markets delivering frankly astonishing returns during 2020, many investors are looking to diversify their equity portfolios. And one area that is attracting consideration are emerging market economies. Yet, does this allocation clash with the surge in investor demand for more sustainable approach to investing? Well, to discuss this, I have the huge delight in speaking to Emily Whiting of JP Morgan, who's an investment specialist for the team and focuses upon emerging markets in Asia Pacific equities. But before we start, as ever, if you haven't already and you are enjoying the content, please show your support by subscribing to the channel and clicking on the subscribe button below. Over here, possibly. It's a big button that says subscribe. It really does help us projecting out our content across the magical interwebs and delivering the message of great quality financial and investment information to you. So let's get into it. Many thanks once again for your time, Emily. Starting off, given the rise in appetite for ESG investing, as I said, should investors shy away from emerging markets, given the typical concerns around governments, climate change, labour conditions, etc.?
Well, first of all, thank you very much for having me. And clearly, I'm not going to say that the answer is no, shy away from EM, given it's where I've made my career. But what I do think that this highlights, and I think you're right, ESG is clearly the area of focus for investors across the world right now. And in emerging markets, we've always believed that it's an asset class you want to be an active manager in. You want to be able to really drill down, understand company characteristics to allow you to differentiate between the winners and the losers. And I think what ESG does is it puts that perspective into focus even more greatly, that you want to be able to understand what's going on under the bonnet of these companies and integrated very much within their long-term success. We've always believed at JP Morgan that ESG is integral to that companies that do the right thing tend to perform better over time. Now, what I would clearly say is the word emerging in emerging markets highlights the fact that they're not there yet. Right. So we're not saying we're buying companies that are already the finished article, that are top notch at everything from an ESG perspective. But what we do find is a huge benefit of working with companies, engaging with these managements as they make that journey through progress. And what we're clearly seeing is a wide divergence in companies that want to build this in, that really take it seriously, versus those that don't. But again, that's where I would go back to the art of stock selection and fundamental stock picking in order to understand those ESG companies and those that are really taking it seriously, as I say.
Yeah. How are these companies within emerging economies addressing sustainable concerns?
And I think it's a very broad answer. It's a very broad asset class. I mean, we're 25 plus different markets, thousands of different companies. So it's very hard to sort of articulate it into one overarching view. But what I would say is you've seen a maturing over the last decade or so of companies taking this more seriously. And if you think about E, S, and G, I think the G, the governance, to us, one of the best proxies has always been around companies paying dividends. They're making a very public statement about wanting to work with minority investors. And so that's something that we've always focused on. But clearly over time, I think the environmental, the E aspect, and more recently, the S, the social side has come to the fore. What we've seen over the last year or so through the COVID pandemic has allowed that S component to come forward far more so than ever before. What I mean by that is, if we go back 3 years, any of us could have articulated what we meant by environmental and what we meant by governance. Social was always a bit fluffier, a bit more subjective and harder to quantify. And what the COVID pandemic has allowed is that social aspect, the fact that companies recognize they have a position as a corporate citizen to come through. So when I look at our products, the Emerging Market Sustainable Fund, we have exposure to a company such as Hindustan Unilever, who donated 20 million plus soaps to Indians that couldn't afford basic hygiene. We hold Yum China, who donated hundreds of thousands of meals to community hospitals. And we've also hold a position in a company called Walmex in Mexico, who really took seriously looking after their micro and smaller suppliers. So rather than paying people on a 30-day basis, shortening it to 7 days to keep the smaller companies in the ecosystem liquid. And I think that has been hugely positive and allow these companies to really express even more so how seriously they take ESG.
Obviously, we're talking about emerging market stocks specifically today, but is there data that compares the ESG efficiencies, as it were, to developed market competitors?
Yeah, and I think data is always that big question. I think the first thing that I would always say is data is clearly useful, but to our view, it isn't everything. We actually believe that the qualitative insight, the fundamental insight, is in many cases more important, trying to find and build up the trust that you have in management. But when we look at data, I think that's one of the reasons why EM has always been more inefficient, because the coverage is often far lower, especially from the sell side. You have issues such as languages and cultures and nuances that mean that things aren't always as directly comparable as developed markets. Mm-hmm. I think the other thing that we find is that the data on emerging markets from third parties can at certain points be fairly misleading and in contrast to our view. And some of that is because maybe those third party insights aren't as granular as we are. They don't have the luxury of having 45 analysts on the ground across the world speaking 22 languages. And so if they don't know the answer and it's not apparent, they'll maybe mark it down as no. So I think these third-party data sets can be really useful as a guide. They're incredibly useful as a comparator across different funds. But we believe that when you build your own fund, you want to be focused on making your judgments and investing off your judgments, not relying on third-party data.
Yeah, I think I completely agree. I think that's absolutely crucial. And one of the real benefits of having such an in-depth and experienced team on the ground is to be able to have that qualitative approach. Maintaining that kind of look through. With regards to the creation of the underlying fund, how does the focus of ESG factors reduce the investable universe?
So I think that straight away, by focusing on ESG and importantly sustainability, we believe that economic sustainability is as important as finding best-in-class companies from an ESG standpoint. You need to naturally realize that your opportunity set is going to look very different from the index. It doesn't reduce it by way of the quality. If anything, it forces you up the quality spectrum because you're purposely looking at the businesses that are run in a better than average form. But I do think it even more moves you away from the index, which I think a lot of investors tend to use as their guide. But I would remind you, I think an index by nature is backward looking. And so to our mind, you want to be looking forward. Mm-hmm. So yes, by way of absolute numbers of businesses, you have an exclusionary framework that some of those are automatically stripped out from. So we have an exclusionary framework that removes anything associated with weapons, fossil fuels, tobacco, UN Global Compact violations, gambling, and so on. So straight away, you lose part of that. Yeah. But in building a long-term quality growth fund, focusing on better than average businesses, they're naturally not going to be the areas you'd be looking at anyway. Mm-hmm. So yes, by way of absolute quantitative size, it's lower. By way of quality, to our mind, it actually pushes you up because you are trying to find the companies that you want to buy and hold and compound those returns. And to us, this very much fits in with how you should be viewing emerging markets. Emerging markets is more volatile by nature. Yeah. You should be looking at it with a long-term lens. And as a result, they are exactly the sorts of businesses you want to be able to be exposed to over the long term and benefit as they grow their market share, they grow their barriers to entry, and become more profitable. Mm-hmm. So I think we continue to feel that there is a huge universe out there for us across emerging markets. And what this does, as I say, is just lifts the quality of the companies that we're investing in.
Yeah. And I suppose to finish up, thinking about the views and thinking about the questions that they have, and certainly I have as a fund selector myself. How different is this approach to your peers, index trackers or traditional active funds? And then also, how should investors view this within their existing portfolios?
Really good question. So I think directionally, we would always anticipate this behaves in a very similar form to long-term quality growth emerging markets funds. when you think about the characteristics that this fund will typically have, so emerging market sustainable equity fund will naturally have in aggregate a higher return on equity for the better than average businesses, more profitable businesses, a lower net debt to equity, so companies that are far less leveraged. What we also find, though, which I think is a huge and really positive outcome and anecdote around this type of product, is we find positive E, S, and G outcomes. So when we think about it from an environmental context, against the index, the carbon footprint is less than 10%. When we think about it from a social aspect, we find that boards are more diversified, there's higher female board representation, more independent directors. And then from a governance standpoint, we find that the companies that we naturally hold are more willing to pay out some of their profits. It's not that we're after dividends as an outcome, but as I said, it's a really good proxy for positive corporate governance. So I think not only do we see good results by way of the ability to generate alpha, the ability to select between winners and losers, but you're in companies that are more robust, with stronger balance sheets, with generating greater profits, and these positive E, S, and G outcomes that are clearly beneficial to all stakeholders. The final point you raise about how should you view this, as I said, we would always feel that emerging markets is a long-term investment. You should be thinking in years rather than months for your exposure. And this type of exposure, I feel, just gives clients not just that positive exposure to emerging markets growth over the long term, but feeling confident they're in companies that are likely to weather storms far better, that they have that downside resilience. We saw that through the COVID pandemic. We've seen it by way of how companies have not just reacted, but also continued to engage with us on the front foot, recognizing their responsibilities. So we would always view EM as a core exposure, but over the long term. You want to be patient. As I said, you want to have a mindset in years rather than months.
Yeah, I couldn't agree with you more. The awareness of the potential volatility, short-term volatility within emerging markets has to be considered. But personally, my two takeaways from this video, first of all, it's really important to have the feet on the ground. It's really important to have that qualitative approach to the analysis without relying upon backward-looking data and just taking things for granted. But then also the quality growth focus within emerging markets and really investing with the good guys, I would suggest. So yeah, I think it's been fascinating to talk. Certainly, ESG approaches to investing has been very, very popular with our viewers. I've no doubt at all it'll continue moving forward. Emily, once again, many thanks for your time. I'm sure we'll catch up soon, and you stay safe.
Thank you for having me. Thank you.